Good morning, good afternoon, and good evening, ladies and gentlemen. On behalf of CLSA, it is my pleasure to warmly welcome you all to our virtual investor event titled Unlocking Potential Sri Lanka's Shift from Stability to Growth. I would like to take this opportunity to extend a special welcome to our esteemed panelists, Dr. Indrajit Kumaraswamy, former governor of the Central Bank of Sri Lanka, and Dr. Gregory Smith, the lead economist and program leader for Sri Lanka, Nepal, Maldives, at the World Bank. Today's webinar will be moderated by CLSA's Head of Research, Mr. Oshtri Bhaskarasekar, and our format today will begin with a moderated session followed by a Q&A session. During the Q&A, the participants can use the Q&A tab to submit relevant questions. And without further ado, I would like to hand things over to Oshada to take things forward. Thank you.
Thanks, Deshan. So, hi everyone. Welcome to our virtual investor event today. So let me start off with the moderated session. In terms of Sri Lanka's external debt restructuring, I think we are more or less now complete with the agreement reached with the ISB holders last week. To start things off today, could I ask our panelists to discuss your opinions of the final terms that were agreed and whether this is sufficient to see Sri Lanka out of the woods? Dr. Kumaraswamy, would you like to start off?
Thank you, Oshada, and let me thank CLSA for inviting me to participate in this event. I would also, before I answer your question, I really also want to initially commend and congratulate the governor and the ST and their respective teams on getting Sri Lanka to where it has got to so far, not just in terms of the negotiations with the bondholders, but the whole debt restructuring process, because we are now, I think, really in the final kind of little few yards of completing the whole process. So kudos to them. They've done a great job. In fact, you know, there has been some commentary from both local experts as well as foreign experts who've come to the country that the Sri Lankan authorities just take what they're given, that they don't negotiate. But I must tell you that I heard from a very reliable source, not somebody who was in the room, but somebody who shared a message with me from somebody who was in the room. And that message basically said that the bondholders had gone into the meeting with a red line. Having heard the governor, Dr. Veerasinghe, they actually went beyond the red line. So this story that the Sri Lankan just lie down and take whatever they are given, it's totally, I think, demolished by that particular anecdote. So they've done very well and they need to be commended. Okay. The deal, and is it sufficient? I won't go into the details of the deal because I'm sure everybody knows that. But certainly if you take everything together, what was done on domestic debt, the agreement with OCC and the China Exim, and now the agreement with the bondholders, and I guess we have a little bit left in terms of the China Development Bank. I saw that State Minister Singh had said that they're very close to a deal with them as well. So as far as the ISB deal is concerned, I think given the circumstances, it's pretty good, right? So more than pretty good. I think, you know, and I think the macro-linked bond gives us flexibility. If we overperform, okay, the haircut comes down. And if we underperform for any reason, the haircut can go up to 40%. And the baseline is 28%, which I think, you know, is generally okay. There is no issue I have with that. Is it sufficient is really the question. Can we achieve at a minimum the DSA's targets, which are, I think, as everybody knows, the debt to GDP of 95%, debt servicing to GDP of 4.5. So bringing debt to GDP down from 125 to 95, debt servicing to GDP down from 9 point something to 4.5, and the gross financing needs down from 34% to 13%. So that is the target. Is this sufficient? Well, it is structured in such a way that it is intended to hit those targets. And we are just waiting for IMF confirmation that they're satisfied that this package will actually meet those targets. Now, the proposal put forward by the bondholders in March, the IMF rejected as not being sufficient to meet the targets. So one would imagine the bondholders on this occasion, would have ensured that it does meet the target. So hopefully it's only a matter of time before the IMF confirms that this particular set of conditions would satisfy the DSA. But we need to be doing more, really, than trying to just hit those targets, in the sense that you have a 3% growth rate, as you know, which is pretty much plugged into the DSA path. We can do better, for sure. I think if we maintain macro stability, do the structural reforms, and also leverage what's happening in India, we can definitely go beyond 3%. And that gives us much more room to maneuver. And it also greatly reduces the prospect of us having to go back for a debt restructuring. At the same time, the caveat is we must hit the primary surplus target of 2.3%. So we need to do both, get growth faster, make sure we hit the primary surplus target of 2.3% for next year, and then 2% beyond that. If we do those two things, I think we will not have to go back for a restructuring again. And on the primary surplus target, the crucial thing is revenue. The room to maneuver on expenditure is not very much. There are a lot of rigidities, but you can improve the quality of public expenditure. And we need to get more revenue. And we can go beyond 15%, in my view, because I think there's a lot of scope in terms of improving revenue through better tax administration, as we are beginning to see, and also these tax concessions. Tax expenditure or revenue loss due to tax concessions, I think the finance ministry put out a figure of something like 970 or 80 billion, just short of $1 trillion we have lost in taxes because of these concessions. So if we take away the concessions, and if we improve tax administration, along with the various tax measures that have been taken and now which are in the pipeline, I think we can go beyond 15%. So if we can work hard to get it at least to 15%, the tax revenue to GDP, and try and go beyond it and go beyond 3% on the growth rate, I think this particular set of proposals would be more than sufficient to ensure that debt sustainability is achieved.
Thanks, Dr. Kumaraswamy. Dr. Smith, would you like to give your thoughts as well on the terms of the agreement, plus whether it's sufficient?
Certainly. So there's been good progress with restructuring over the last couple of weeks. And I think, you know, the stepping back a little bit, the big ticket items were a domestic debt reduction through the optimization program, which was successful, a restructuring of the foreign bilateral debt and the foreign commercial debt, and a restructuring of CPC and the Sri Lanka Airlines bonds. And so in this tick list, the government's moved a long way down that line. And I think they'll have to get through that list if they're going to see meaningful change in the credit rating. So on to what's happened in the last couple of weeks. So at the Paris Club meeting, they announced the final agreements with China Exim Bank and with the Paris OCC creditors, which is the Paris Club plus India plus others, leaving the Eurobonds, which they manage, at least with the foreign ad hoc bondholders, they've managed to get this agreement, and we've got two hurdles to get through, which I'll go on to in a moment. And then there's conversations ongoing with the domestic holders of these of the Eurobonds at the moment as well. So in terms of what the government and bondholders agreed, obviously the IMF need to give the green light that it's consistent with the DSA. and the official creditors, China Exim Bank and the OCC, need to say, hang on, this is fair. There's comparability of treatment here. The IMF's made some headlines saying that it needs a bit more information, and they're right. We did get a lot of information through the London Stock Exchange and Singapore Exchange presses. We got the note on the Ministry of Finance website, which is very useful if you haven't seen it yet. And then a link to some of the slides put together by the advisors. And there's a few questions you're left with, particularly about the governance-linked bonds and whether one or two of the vanilla normal bonds will be converted to a governance bond, and we need the details of those triggers. But there's a lot of information there to crunch, and I think it looks, at least in my opinion, the IMF. I think there's enough there for the IMF to accept it from a DSA perspective. I think for the official creditors, it's interesting because going back a few years, comparability of treatment was very much a notional thing. It was an idea. It was something agreed sort of among human beings. And there's been this shift over the last 5 years that we must be precise about this. And so in some ways, it will depend on how the OCC assess comparability of treatment, because they've got two very different sets of agreements, and that's because different types of creditors feel pain in different ways. And for the bilateral creditors, it's very much about grace periods. It's very much about much longer maturities. They'll quite happily take longer duration not to get a haircut, whereas private creditors will take a haircut in order to get cash flows faster. And so to assess and then you've got there's the fact that there's these variable rate instruments on dollar GDP and also potentially on governance to do the maths on. And and then there's a question: do you assess comparability of treatment using the IMF baseline, or do you use a probabilistic approach? So we go on from that, and we throw all this complexity in. So my view is that the Paris Club tends, at least from recent papers, to think about comparability of treatment in an NPV sense, using various discount rates, not just the 5% in the IMF and World Bank DSAs, but also discount rates that are a bit higher and towards the 11% that the Ministry of Finance published and that bondholders are more likely to use. So, and then they'll also look at duration and nominal cash haircuts. So I think on the whole, there's enough there for the OCC to accept it, but it really depends on their methodology. But they could create a story and applying quite low discount rates and an argument. But again, I think like with the IMF, I think there's enough there for this to go through. But we do need to wait that actual decision, which would and then before a proper exchange would happen in, say, September. I think stepping back, the government has negotiated well, but this country still has a massive debt interest burden post restructuring. It still has a massive debt post restructuring, and that's because the DSA that was published in 2022 didn't require a large debt reduction, and that's partly because it was on the FX and growth forecasts that were baked into that 2022 DSA. When the economy did better than that and outperformed it, the mileage needed to get to the debt targets was much smaller. But people haven't been able to change that over the last 18 months. So I think this deal reflects the DSA, and therefore it's got to be commended. But the caution has to be with the fact that when you're coming out of a restructuring with 50% of revenue taken by debt interest payments, you're on a knife edge, and that's a term that the IMF have used. And it's going to be incredibly hard for Sri Lanka to perform this balancing act. And on the one hand, it might be able to outperform on growth, but the fiscal road ahead is incredibly tight. And we've, I think in recent memory, there was some small primary surplus in 2017 and 18, and then I think you have to go back to 1992. So under this program, the government, has achieved one primary surplus and is likely to achieve another, but to go on and achieve repeat primary surpluses over 2% of GDP, that will be a historical achievement, and that'll be huge. And there are questions whether such a primary surplus will interfere with the growth rate. But I think if the reforms go through in terms of making the economy more competitive, attracting investment, then growth of 4 and a bit % would make a real big difference to ultimately to the debt stock. And I think when everyone talks about getting through an IMF program and moving away from a cycle of boom and bust, moving away from cycle IMF, revenue is essential, but the key factors are always growth and ability to create to attract flows that are non-debt FX flows. And that is going to be what's needed. Otherwise, you end up on another IMF program. Otherwise, you end up in danger of restructuring again. So it's an achievement and it's to be celebrated. I think it's consistent with the rule book, but everyone needs to acknowledge how large and the debt burden and debt risks are going, post restructuring, and that will limit the government's choices, whether you look at it from a foreign debt perspective or the huge amount of T-bills that will need to be rolled. There are huge debt pressures that will continue.
Thanks, Dr. Smith. So moving on to my next question, I think the IMF growth forecasts are generally viewed as quite conservative. Dr. Smith, if I may direct this question to you, what do you think is the most probable scenario on the haircut for ISBs? Is it the baseline scenario or a lower haircut? I think Dr. Kumaraswamy already mentioned in his opening remarks that Sri Lanka probably can grow at higher than 3%. So what are your thoughts on that?
Yeah, it's the trigger in the ISBs, the Eurobonds, is dollar GDP. So we need to think a little bit about real GDP growth, and we also need to have an eye on the exchange rate. And that, in some ways, there are scenarios where the dollar's very strong, the dollar's very weak. If the US goes into financial difficulties or not, all of those things will potentially impact on the margin. But when I look at, the bonds haven't moved much, they haven't moved since the sort of rally in the first quarter of this year. And I think the market is pricing certainly threshold 3, which is what's that? That's something like $92 billion over the IMF baseline of 88 and a bit. And I think that's partly because of the uncertainty about the election ahead. But I think once the uncertainty of the election is gone and there's an idea that there's policy continuity, then the bonds, I think, could trade better and sort of look at more of a threshold 296 billion scenario. I think it would take quite a reform effort for pricing to reflect threshold 1 and breaching the $100 billion mark for the economy on average. I think that would be a big step. It's not impossible, and I'm actually, I think it's very possible with the right reforms, but I think that's going to take several quarters, maybe all of 25 to sort of build the confidence that this economy is not just growing, but it's on a clear reform path as well. There's been a remarkable stabilization of this economy, but there's still a huge amount of work to do. So I think, the market's sensible to be pricing threshold 3, and then maybe without election uncertainty, it goes up a little bit.
Thanks, Dr. Smith. Dr. Kumaraswamy, if I may
can I just add a few remarks to what Greg said? Anyway, first I want to thank Greg really for 2 sets of very insightful comments, which I think are very helpful for all of us. And I want to kind of re-emphasize what he said about us continuing to be on the knife edge. I think my kind of initial euphoria is a strong word, but my upbeat response at the beginning is actually the progress that has been made over the last couple of years in terms of the whole debt restructuring, I think, and I think what the authorities have been able to achieve in line with the DSA, as Greg also conceded. But we are finishing up in 2032 with 95% of GDP, debt to GDP ratio, right? And Ghana actually defaulted at 93%. Now, Ghana is a low-income country, Sri Lanka is a mid-income country, and therefore, by definition, should be able to carry a heavier debt burden. But given all that, I think that gives us an impression of where we are ending up, where we are landing, which would still be in a very vulnerable place, which is what I think Greg was emphasizing. So there is absolutely no space. I mean, we have to completely change our mold of economic policymaking, right? I mean, the macro, this kind of stop-go policies and dramatic policy reversals around elections, that kind of scenario, if we just have to move away from that. If we do not, sure as night follows day, we'll be back with another debt restructuring and a set of austerity measures, which are even tougher than the ones that we've just experienced. So this is absolutely the knife-edge story is absolutely crucial to keep in mind. But as Greg also implied, there is a path. There is a path for us to achieve that sustainability, to have higher growth, to have more inclusive growth. All that is possible. Those are reforms that have been talked about for many years, but have not been implemented. So that's what the crucial thing is. If we implement the reforms, there is definitely an upside scenario there for us. If we fall back to our old ways, then we have a serious problem. Now you were going to ask me another question.
Yes, this is on the local banking sector. Given that they hold about 12% of the ISB stock, do you think they have sufficiently provided for the ISB exposures, or will this create more capital calls?
So as Greg mentioned, I think there are still some negotiations ongoing with the domestic banks which hold ISBs. But on the principle of equality of treatment, I don't see they're going to get a more onerous set of terms than what the international ISB holders, the external ISB holders have got. And if one goes by those terms, the banks have already provided more than enough. I think the provision's at least 45%, right? In some instances, it's up to 50 and a bit more. So that's
52%.
52%? Okay. So 52% clearly should be more than enough in terms of provisioning. So the question then becomes, when do they release some of that provisioning? And given that we are in a macro-linked bond, and there's a whole range in terms of the haircut between 15% and 40%, they would need to time their release of the provisioning carefully and monitor the performance of the economy. I think it's up to each bank to work out how they think the various scenarios are likely to play out and are playing out as time goes on. And clearly what happens during the elections will be important to take some kind of call on how likely we are to achieve that sustainability. So to answer your question, I think at the moment they're okay, right? They've in fact over-provided. As to how they move away from, they scale down on their provisioning. I think that's something they would need to take a call on as the performance of the economy kind of rolls out in the period ahead.
Thanks for your thoughts, Dr. Kumaraswamy. Dr. Smith, if I may ask the next question from you on the commercial debt restructuring, the IMF obviously has to approve it. How long do you think that could take potentially? Plus, on a potential credit rating revision for Sri Lanka, do you think the rating agencies will wait till the elections are over to conclude on any upgrading of the rating?
On how long the IMF takes, yeah, it's a difficult one because they've asked for more information and it's a question of whether they get that information and how quickly they can make a decision. They've got bright people in their team who could certainly crunch the numbers and know the DSA inside out. So I'm sure once they get the information, they can come to a decision. And there is a pressure with the, if we take a step back of the sort of pandemic era defaults, Zambia, Ghana has been done. So there's the pressure to get these moving faster. So I kind of hope, and I can only hope that it's done quickly. On credit ratings, I don't think they care about the elections. I think once a country is out of default on external debt, it's kind of mechanical, and then there's a whole process of Sri Lanka trying to claw back its rating to a decent level. But where I'm not completely clear is how one defines external default, right? So certainly the bonds are there, but we've also got Hamilton, who allegedly own a controlling stake of the 22s, and who there was a stay that expires, I think, quite soon. Maybe it was 1st of August. I can't remember off the top of my head. For a $250 million piece of legislation, so that still hangs around, as does the Sri Lanka Airlines external bond. So there's been sort of media in the week that I've read through on Sri Lanka Airlines, and all of that's very topical. So my question to myself is, at the moment, do each of the rating agencies need to see those resolved before they can shift, and do they have to wait for the actual exchange, which is likely to take place in September, if according to what I've read this week. And then well, yeah, I think that's both of your questions, I think.
May I just ask Greg a question, if I may, please?
Sure.
Yeah, just to say that, now my understanding is that we start servicing the interest in September, I think, if I'm not mistaken. Am I correct in assuming that once we start servicing the interest, that the rating agencies would not keep us in default status, that they will then take us up to kind of CCC or whatever it is, so we can, once we start paying the interest in September, by then expect some to be taken off default status. But the challenge is then to move from there to a rating that gives us market access. There, I think all the things that you've been talking about, but what happens to the Sri Lankan Airlines bond, the case, and also our performance, the way the rating committees assess the metrics in terms of their model and their assessment of the risks involved, all that becomes more challenging for us. Mm-hmm. But we would, I think, move out of default status fairly quickly. Am I right? But getting to B- and say market access, that be a lot of things that we need to get right to do that. Is that a correct kind of appreciation of what
I think absolutely, on getting to B-, it's a huge task to shift from a risk rating of CA1 on the Moody's side or CCC+, where a lot of frontier sovereigns sit at the moment with high debt loads. So absolutely, that with these debt service to revenue ratios, it's going to be incredibly hard even to get to B-. So I think on the second part and on the first part, as I said, I'm trying to work out exactly what's needed for that but great to hear. But that, you know, it's plausible that the exchange and the payment on the new bonds will be enough. That, and if that's the case, wonderful. But one would also like to see these other problems to go away in terms of potential litigation at some point. So, but you know, back to where I started, there's been tremendous progress over the last 2 weeks. We're not out the woods yet, but there's tremendous progress. So yeah, I just don't, my honest truth is I just don't know the answer. I need to go back and look at the rating reports in more detail. They were triggered into selective default on the Eurobonds, but do they need the other bits to come out? As I said, I just don't know. And then on getting the rating back, yeah, it's so it's the metrics that I think, you know, rebuilding buffers, FX reserves needs to continue, and you know, with the PBOC swap, we're, you know, 6.3 billion, 6.279. And then, you know, getting reserves back towards double digits, $10 billion, say by 2027, will be huge, and that will help. And as will be the debt service to revenue ratio, which will be achieved through better growth, basically, so that less of the domestic debt certainly needs to be rolled over. And this country needs market access. And when you go through a restructuring with a market access DSA, you're basically buying an air pocket. You're buying yourself some breathing space to be able to get back to the markets. Now, the IMF are going to lend. They've lent Sri Lanka 2 billion. They're going to put another billion in, and then they take that money out. So you kind of need market access in 2027 to be ready to repay the IMF. That's crucial. So it's a must to try, you know, because someone's got to come in with new money from 2027, and it has to be at scale in the billions of dollars. So hopefully the growth, the reform, and the credit rating are in a position whereby the country can borrow. In many countries have borrowed at CCC plus at okay rates. It depends on the country story, particularly if it's refinancing rather than new debt. But it, you know, in general, it is certainly more expensive than if you had a upper single B rating or even a double B, which could take 5, 7, 10 years to achieve. Who knows? It's incredibly hard for countries to claw back to where they started, and I think that was where Sri Lanka started back in 2005-07 when they got the debut rating. So there's a lot of work to do, but not to sound so downbeat, but I think with just a path of not making large policy blunders, this economy can grow at more than 3%. And as Doc alluded to, you know, the passenger growth, the coattails of India and Bangladesh at the moment, the South Asia region is the driver of global growth. It's where the positivity is, and for Sri Lanka to be part of that as it emerges from this crisis is exceptionally well timed.
Thanks, Dr. Smith. Dr. Kumaraswamy, as Greg mentioned, Sri Lanka does have some breathing space now till around 2027 or 2028 for us to put the economy on a sustainable path to recovery. Could you shed some light on how we can achieve this transformation, and are we competitive enough to attract sizable investments and non-debt inflows to support our growth?
So I think the first thing to say is and I think Greg put it very graphically, you know, they've just created a little pocket for us, right? An air pocket for breathing space, as you put it. And we need to be very aware. And as he explained, unless, you know, we are in a situation where we can attract have both market access and attract non-debt creating inflows, we're not going to get out of this in a sustained way. And And to answer your question, are we competitive enough? Clearly, no. You just have to look at our record of attracting FDI, going way before the crisis, right the way, we've never attracted serious amounts of FDI. And also, if you look at our export transformation, we're not competitive in export markets in a very material way, in the way we need to be. So there's a lot to do, and we really need to see this if and when, and I think we will complete the whole restructuring process, because we just have a few what are largely administrative things to get through to complete the process. But we need to look at that as only the beginning, because really to get out of this cycle of sequential bouts of macroeconomic stress and austerity packages and IMF programs, 17 of them and all that, to get out of that, we have to transform our economy, right? And as you implied in your previous question, that can only happen if we build an outward-looking, competitive economy that drives growth through export transformation, which generates, more higher value employment opportunities. That's where we need to get to. So this debt restructuring and completion of it is the starting point. So we should take great pride, and I think our folks have done extremely well to get us to where they've got us to. But that is creating the platform for us to eventually get to where we have to get out of this cycle once and for all. So this is the start, not the end. We are very quick to become very complacent as a people, that we have our highs and lows. So we need to really understand this is the start of the journey. We have struggled and got ourselves up to the starting line. Now we have to become an economy that's competitive globally, and which then gives us kind of sustained growth and employment generation. So, and for that, we know what has to be done, right? All these things about factor markets, about SOE reform, the investment climate, investment promotion, trade policy, particularly trade agreements. Everybody else has got, I don't know, Vietnam has some 20 or something trade agreements, if I'm not mistaken. Greg might know. And, we're way behind on that. And trade facilitation, lots of things that can be done, the single window. So many simple things we've known about for a long time, but vested interests have prevented us from doing that. So we need to do all that. And of course, education, training, and skills development, even more important given the migration trends that have taken place in the last couple of years. So, and a lot of that stuff is in the economic transformation bill. We need to now get it all done. And as I said, that's why I said this is only the beginning. Thank you.
Thanks, Dr. Kurmaswamy. If I may stay with you, in terms of, the Sri Lanka's track record has not been great with IMF programs and reforms. Now that we are approaching elections, as you mentioned, the economic transformation bill, do you think that will be able to ensure that we more or less remain on track with the required reforms this time around?
So if we implement everything that is in the economic reform bill, then I think we'll be well on our way, yes. But that's a long way off still, right? We identified the problem 40, 50 years ago, but we haven't resolved it. But this time around, we have really probably no choice other than to reform it. And if we think we do, and we do one of our usual kind of policy reversal efforts, things that will not look very good. So, I think it's a good thing to try to understand why is it. We've known that we had to do these structural reforms, right? I was in the finance ministry on secondment from the central bank in the 1980s, and this story I've told before, so I apologize if some of you have heard it before. I was Mr. Ronnie DeMel, the late Mr. Ronnie DeMel's bag carrier in the 1980s in the finance ministry. I used to go around listening to him. And all the things that we are talking about now in terms of structural reforms, he spoke about as finance minister in the 1980s, and we never got it done. So the question is, Why is it that it doesn't happen? It doesn't happen because there is an unholy nexus of vested interests that prevent it. Structural reforms are beneficial for a large number of people in the economy. But there are losers also. And usually that the nexus that loses is politicians, bureaucrats, and some businesses, some private sector. So those folks are much better off in a closed system where the outcomes can be fixed. And they are very powerful and they resist. They resist change. And this is what has been going on now for 30, 40 years. So unless we break that nexus and drive through the structural reforms and create this open competitive economy, we are not going to get out of this. So that's crucial. So there is a political economy factor here as to who has been blocking these reforms. We need to try to understand that and then try to get that unblocked. But the Economic Transformation Bill, I mean, people say there wasn't enough consultation, all kinds of stuff. Maybe true, I don't know. But it has pretty much everything in there. But it's very tough to implement, partly because of the vested interests, partly also simply because of the size of the agenda. I mean, setting up a whole lot of new institutions, etc. It's not easy. But we have to make a big effort, a big push, and try to get that stuff done and to construct this open, competitive economy. Thank you.
Thanks, Dr. Kumaraswamy.
Sorry, one more point. You know, in terms of the electoral cycle, in the last two election cycles, the most dangerous, the most policy destructive periods were the periods between the presidential election and the parliamentary election. In 2019, in the lead up to the election, there was some slippage, but Mangala Samaravira was finance minister and he did his best to hold the line. But then straight after elections, you had those tax cuts and, you know, a really totally unsustainable budget in order to get a 2/3 majority in the parliamentary elections that followed. In 2015, the Yapalna government was elected and it presented a totally unsustainable interim budget in February 2015 to be able to win the parliamentary election. So the dangerous time is after the presidential elections, and if whoever comes back into power thinks they can let the fiscal discipline go in order to ensure their success in the parliamentary elections. That's what's happened the last two cycles. So that has to be avoided. And I think that people need to be very aware of it, and they should make sure that they let the powers that be, all parties, know that that is not something that they're going to tolerate this time around. Thank you.
Thanks, Dr. Kumaraswamy. Before we go to the next question, just a quick reminder to the participants on the call. We are nearing the end of the moderated session, so if you do have any questions, please do send it through the Q&A tab, and we'll pick those up when we start the Q&A session. Yep. So coming back to my last question, it's on the interest rates, specifically the treasury bill rates. We've seen it rise by about 1.5% over the past few weeks, despite all the positive developments in other parts of the economy. So, Dr. Smith, if you could give your thoughts on this, what kind of drove the treasury bill rates upwards over the last couple of weeks?
My best guess is just the sheer weight of T-bill rollover that the government has, that the fact that it's going to need the market so much was probably enough, despite, you know, taking the excellent record on getting inflation down to low levels. So I think that's crucial, and there's been a huge chain of good news, but that need to roll over a large amount of domestic debt remains. So I think that's probably one of the reasons why it sits where it does.
can I just say something as well? I think that's right. I think Greg is absolutely right. But you know, the volume of treasury bills issued in June was extremely high. Much and the issuances exceeded the maturities. So you know, they went beyond the rollover. So my own impression is that the government had a cash flow issue and they needed to raise some money because you know they can no longer rely on the central bank. So that may be why they issued more than the actual maturities. And the volume of the issuances, as Greg said, was probably a factor. And what we need to now, I see that the issuance, the first issuance in July, I think, was it? Or at least the last issuance was actually less. The volume was less and the yields were flat. So we can wait and see what happens in the next few. Because the liquidity in the market still seems pretty strong. I mean, it's still over 100 billion, I think. Though there was a bit of a dip. Another factor is the central bank is probably not buying dollars as aggressively from the market as it was. You know, I think it bought about $2 billion year to date. It has bought about $2 billion year to date. So that may again be a source of liquidity that may not maintain the same momentum. But it'll be interesting to see what happens in the next few auctions, because the size of the auctions came down in the last. The size of the auction came down in the last auction, and seemed to have released some of the pressure because the yields were flat. So we can wait and see what happens in the next 2 or 3 auctions. That'll give us a better clue as to what's happening, the dynamics of the treasury bill market.
Thanks, Dr. Kumaraswamy. We will now be moving on to the Q&A session. We've already got a few questions from the participants. So the first question is on the establishment of a debt office. So if you could share your views on the establishment of a debt office, I think that would be helpful. Dr. Smith, would you like to take?
Sure. And I think when you know, there's a bit of commercial borrowing in the early 2000s, 2007 debut. So if we take that period, I think a lot of countries came into the markets on low global interest rates and were operating in a kind of almost like aid recipient manner, in that they would sort of, some ministers would fly to a financial center, do the bonds, and then countries would wait until a particular bond came due and make the payment, and that was it, rather than thinking of sort of more active and modern debt management. And I think, so number one, I think if you're going to succeed in global financial markets as a sovereign, you need to be what I call active rather than passive, and work to reduce your refinancing risks along the way, just in case the market closes. Sri Lanka had a strategy which required the market to be open. So when it shut in 2020 and then opened up for everyone else, but was shut in 2021, the government ended up in default. And part of that is because they took so much net financing in 2012, exactly 10 years before 2022, but didn't do anything to sort of reduce that burden. So 2022 was always going to be a difficult year to repay. It just came after several shocks, which made it impossible. So modern debt management, active, looking actively at refinancing risks. And then when I also look at the period, say 2010 to 2017, debt to GDP in Sri Lanka is really steady, and it hovers around 70%. There's, you know, about, with a sort of equal portion of domestic, and so the economy's growing about 6% on average. Debt to GDP is kind of static. So people are like treating 70% debt to GDP, not like a debt limit, but more of a target, and they're borrowing along the way. But meanwhile, the real vulnerability is being flagged in debt service to revenue, and external debt to exports, which is deteriorating along that line. So I think a modern equipped debt management office would actively be searching for the risk rather than just having a conversation about sort of one or two measures of debt. They'd be actively feeding in information to parliamentary committees, to discussions on debt, to be able to flag risks in advance and try and nip them in the bud so that when a series of shocks come, the country is much less vulnerable. So that active debt management, thinking about repayment beforehand, and that almost like sort of, and middle office searching for risks. And then on the other side, a functioning modern debt management office has all the IT skills, it has that strategy, but it also has an active front office that can talk to investors, can provide them the information they need and reduce the uncertainty. Because when you look at frontier market pricing, there's a chunk for probability of default, there's a chunk for illiquidity, and then there's a big chunk for uncertainty. So if you can work to reduce that uncertainty and get more investors familiar with your story, then I think over the years you can reduce your borrowing costs a little bit. And I think that would be best performed with a debt management office. And if I look back to the 2016 IMF program, people talked about the debt law and the debt management office. The good news is the government's been successful in passing the debt law, and this office is due to be established and operational in the next couple of years. So hopefully these steps become real reform. And I think then the government, when you need $1.5 billion from the Eurobond market in 2027, in 3 years' time, you're ready and you have the skills in place to borrow better from the markets.
May I just add something to that, if I may, Oshadi?
Yes, sure,
Yeah.
Dr.
So, I think in addition to all the stuff, the valuable stuff that Greg said, a couple of things. One is the system as it has been is highly fragmented. The bilateral and multilateral debt are handled by the External Resources Department, who also have the debt management and recording system, the data collect thing is in the External Resources Department. The ISBs are handled by the central bank, and the syndicated loans are handled by the Treasury Operations Department. So it's all fragmented. Three entities in government handle these three different types of debt. So bringing it all together makes a lot of sense. The other thing also is taking over debt management away from the central bank, removes a massive conflict of interest. The central bank primary responsibility is price stability and financial system stability. At the same time, as the agent for the government in terms of debt management, it is expected to raise money as cheaply as possible for the government. So clearly there's a conflict. So efforts are made within the central bank to create firewalls, etc., but it's a suboptimal situation that has prevailed. So taking it away from the central bank, debt management away from the central bank, I think is a very positive step. The other thing is, I think just by way of a couple of observations, there is a medium-term debt management strategy that was published in March 2019. It set out the way that at that point, the authorities were trying to manage the debt, which was already very fragile. The debt profile was extremely fragile. But there was, in fact, a strategy that was developed. It codified what was being done in the previous years. But that somehow, as things happen in Sri Lanka, as governments change, I don't know, that has disappeared into the ether. Nobody talks about it. Nobody, I think, even knows about it. But anybody can Google the Sri Lanka debt management strategy. It is now out of date after the default, clearly. But that was a strategy. And the other thing is the Active Liability Management Act, which was passed also, I think, in 2018, if I'm not mistaken, which was intended to give the central bank more instruments. How it did that to manage debt, how it did that was before the Active Liability Management Act, The Appropriation Act set out the borrowing requirement and how much was going to be borrowed at domestically, abroad, etc. And so one only borrowed as much as one needed for the use of the government. What the Active Liability Management Act did was to give the authorities the opportunity to approach the markets opportunistically when the conditions were right, to go into the market and borrow money, which would then be earmarked for liability management. Again, on each occasion, you had to get parliamentary approval. Interestingly, the first such operation was scheduled for October 2018. And on the day the parliament approved that first transaction under the Active Liability Management Act, the government changed. If you remember, there was the constitutional crisis when the Yapalna government was replaced by a government headed by former President Mahinda Rajapaksa. And with that, we lost the opportunity of going to the markets, and it fell away. But that is still there in the books. So you can use that to build up a buffer, which can help you with, I mean, Greg would know, I'm not very familiar with all the techniques for liability management that there are, but there is a whole industry. I remember various bankers coming and briefing us in the central bank as to what was possible in terms of liability management. So that scope is still there to use the active liability management. Once of course, we have to get market access. Can't do anything of this before that. But after that, there is that instrument is available as well. And the debt, I think the debt office focusing entirely on these issues would be well placed to, as Greg has suggested, to manage the whole thing in a kind of holistic way.
Thanks, Dr. Kumaraswamy. If I may stay with you for the next question, the question basically asks on the ISB payments, which are kicking in of about $770 million from 2024. Do you think this is the right time for us to relax the restrictions on vehicle imports?
Okay. So we have some treaty obligations. Clearly, if you remember, there are some WTO obligations I think we have signed up to. I remember the EU, when we first started introducing these import restrictions, before the crisis really hit, I remember the EU ambassador on more than one occasion expressing dissatisfaction about the introduction of these import restrictions on vehicles. So there is, I guess, as I said, WTO commitments that we need to adhere to. And so you can have high tariffs to regulate imports, but to use quantitative restrictions is a problem in terms of our WTO commitments. So at some point, you can, there is a provision in, as a kind of a exigencies of the circumstances, whereby in a crisis you're able to use these quantitative controls. But now that we've got an IMF program, we're coming close to restructuring our debt, it is more difficult for us to justify these restrictions on the basis of a crisis. So at some point, we may need to phase them out. And hopefully our reserves are strong enough, and our capacity to attract non-debt creating inflows is on an upward trajectory, which enables us to meet our WTO commitments without undermining our external balance. I think there is also, under the Article 6 of the IMF also, we signed up, and I think you can't use quantitative restrictions for current account transactions. To the best of my knowledge, I think that is also another limitation that we have, which we need to take account of.
Thanks,
So
Dr.
I think
Kumaraswamy.
we have obligations to take them away, but hopefully our performance improves to be able to absorb that.
Right. Thanks, Dr. Kumaraswamy. Moving on to our next question from the audience. Dr. Smith, if I direct this to you, the question asks, when will Sri Lanka regain market access? I think we discussed this earlier, but if you could just quickly recap, I think that should be enough.
The design of the IMF program is such that market access isn't needed until 2027, and that's I kind of think it's consistent with the new bonds that would be exchanged. So it's a question of preparing for 2027, really, because that's the point in time where IMF switches from being a net financier to a positive net financier to a negative net financier. So I think it's really about building the credibility back for 2027. The beauty of the debt restructuring is that you have that breathing space and you do not need market access before 2027. And then we're dreaming about, where's the Fed going to be in its rating cycle, what's going to be the state of markets, etc. But who knows with that sort of timeline.
Thanks, Dr. Smith. Next question is basically goes as, why isn't there a 1-month treasury bill and why aren't there variable treasury bonds? Dr. Kumaraswamy, would you like to take that?
Well, so we have 3, 6, and 12 on the treasury bills. I mean, what is the advantage of having a 1-month treasury bill? I mean, in terms of mopping up liquidity, etc., or I don't see a clear advantage in terms of having a separate 1-month treasury bill instrument. So I think as the current structure of treasury bills is pretty fit for purpose, to the best of my knowledge. I don't think it in any way hampers monetary policy implementation or the government's financing. But to the second part, one was the 1-month treasury bill, bonds, variable bonds. I think that would make cash flow management for the government very, very difficult. That's one disadvantage that immediately comes to mind. If you raise money through variable bonds, I'm not aware of any government. Greg might be able to help us. I'm not aware of any government that issues variable bonds to raise money in the market. So that would just create too much volatility in terms of the pattern of financing. I don't know whether Greg would like to say something.
Yeah, I think the complexity would be a real pain. You don't tend to get complex things in vanilla issuance or in standard issuance. They tend to come in at a restructuring where there's a debate about upside and downside and forward-looking forecasts. But I think for the most part, it's best to keep things simple. So I wouldn't personally think that would be a sensible addition to the government's issuance.
Thanks to Dr. Kumaraswamy and Dr. Smith. Moving on to the next question. The question basically asks on when bilateral lending could possibly resume, and basically on how soon we can expect the bilateral finance, the construction projects to resume. Dr. Gomaraswamy, would you like to take this?
Okay, let me have a first go. I think as soon as the restructuring is completed, I'm going by what the Japanese authorities have been saying, because they have basically been saying that they will restart the projects that have been suspended as soon as the debt restructuring is completed. And also that they would consider new projects. And I suspect that would apply to all donors who I think whose own laws probably permitted lending, whose own laws prohibited lending to countries in default. And now as we are shifted out of default status, I think that would open up bilateral lending again.
Thanks, Dr. Gomaraswamy. Yeah, the next question is in terms of the external debt optimization, the baseline scenario has been given in line with IMF predictions. Would like to know what is the exchange rate and GDP growth rate considered for baseline GDP calculations? And Dr. Smith, would you like to take that?
Yeah, I don't know the answer to that.
I will say I don't either. Yeah.
Sure. So moving on to the next one, are there any case studies upon which Sri Lanka can model its return to sovereign creditworthiness? Maybe Jamaica. Dr. Gomaraswamy?
Well, yeah, Jamaica actually, I think, is a very good example. It's a good example for you to have cited. You know, the Jamaicans were very similar to us. I had some experience of working on Jamaica when I was working for the Commonwealth Secretariat. Their politics was very similar to us. There was a left of center party, which was led by Michael Manley, and there was a right of center party, which was led by Edward Seaga. And their politics was very similar to us, highly adversarial, highly contested, and policy reversals all the time. I mean, you could basically just the narratives of the economic history of the two countries were exactly the same. And Jamaica also had a very narrow export basket. It was essentially tourism and bauxite, if I remember correctly, similar to us. And they got into serious trouble. They were a middle-income country, got themselves into serious trouble. And now they've come out of it. And one of the critical determinants of the turnaround in the Jamaican economy has been an agreement that has been signed by the two major political parties. You know, I can't remember the name. I think the Jamaica Labour Party, and I can't remember what the right of center party was. Both of them have got together and have actually now signed an agreement. So what is crucial for us also in terms of going forward is consensus and continuity. You know, the Indians had the major crisis in 91. Then there has been a consensus between the Congress policies of Manmohan Singh and his governments and the BJP policies of Prime Minister Modi's government. So while we have these in 2019, we had a 180-degree policy reversal. You know, a lot of the things that we're doing now, flexible inflation targeting. There was a monetary board decision not to participate in the primary auctions for treasury bills. Small, but some primary surpluses were achieved in 2017 and 18. Two of only, I think, 5 years since independence that we've had a primary surplus. So we were kind of on the right track. And then we had a 180-degree reversal in December 2020. And that has happened in the past. This was the most, I think, vivid example of a policy reversal. The Jamaicans have taken out that risk by both major parties signing up to this agreement on the broad framework of policy reforms. And not only that, to the best of my knowledge, I think they've created an independent commission of some sort, which would basically adjudicate on any kind of contention that arose by one or the other parties deviating from the agreement. So they put up that structure, and it has really paid off for them. So I don't know whether we need to create that structure, that kind of architecture, but we certainly need to get that in practice. We need to have consensus continuity going forward.
Thanks, Dr. Kumaraswamy. Next question is on, can you comment a bit on capital infusions to the state
just a
bank?
point on Jamaica, which I think, sorry.
No problem, Dr. Smith. Please go ahead.
Just really quickly on Jamaica. So they got their, over 10 years, they got their debt to GDP down from 140% down to 70. And they did this through primary surpluses averaging 6.6% of GDP. So
Wow.
which is just phenomenal, right? In terms of fiscal discipline. And they were, but the cost of this was growth for an entire decade, averaged 0.9%. So I think there are elements you want to take from Jamaica, but I don't want to see a Sri Lanka that grows at 1%. I just don't think it's palatable. I just think there needs to be more prosperity in this country. So for I think Sri Lanka needs to grow at 3 or 4%. You can't settle for 1% growth. And if you run such strict fiscal, it'll be dire for growth. And so Jamaica has traded growth for low debt. And they were able to do that in a sense and not have protests because government revenue has averaged 28% of GDP. So when you net out interest payments of 7%, you can spend 21% of GDP on education, on healthcare, on infrastructure. But in Sri Lanka, you've got 14% revenue. So if you take out interest rates, you're left with 7% GDP to run the country. So you're going to be signing up for a fiscal straitjacket with 7% GDP spend primary. And that's just a recipe for protests. And it's just not politically feasible. So be careful what you copy from Jamaica. There are some really wonderful things in terms of the way there's cross-parliamentary agreement on fiscal. But if you bound your fiscal like they did on your low revenues, you'd have nothing to spend. And I think that would be dire.
Thank you very much, Dr. Smith. Moving on to the next question. Can you comment a bit on capital infusions to the state banks and on what timelines? Dr. Smith, would you like to take this?
Yeah, I can't speak on that matter, sorry.
Okay. Dr. Kumaraswamy, anything you can?
Well, I mean, there is that provision in the budget, right? Is it 400 billion? I can't remember the amount, but there's a large allocation in the budget for state bank recapitalization. But so there is that provision, but I do not know the timeline for using that money or whether they're going to use it at all.
Okay. The next question is, could you provide any insights on the quantum of debt repayment to bilateral and multilateral lenders in the next 6 to 12 months and your views on the LKR as debt repayments start? Dr. Smith, would you like to start off?
Ridiculously, that information is not yet public. The president has made a few remarks that were picked up on about interest rates and about grace periods, but ridiculously, we're still waiting for those documents to be public. And I think what will probably happen, my best guess, is the OCC would release that information at the same time as, say, China Exim Bank at some point in time. My view is that information should be in the public domain, but frustratingly, it's not in detail. So yeah, you can pick up little bits from the media, but I think that information needs to be public as soon as possible.
Thanks, Dr. Smith. There's another question actually directed to you. Going as would reverse engineering sovereign credit methodologies provide a useful set of policy targets for a return to sovereign credit worthiness?
I don't understand the question, sorry.
Would reverse engineering sovereign credit methodologies provide a useful set of policy targets for a return to sovereign credit worthiness?
Yeah, I don't understand it. Sorry, I can't answer that.
Sure. We'll wait to see whether more context comes in on that. In terms of the next question, given that the losses of the SOEs are on the balance sheet of the state banks, is it not the macro-prudential duty of the central bank to prevent credit outflows to them from the state bank if they have unsustainable pricing? Dr. Kumraswamy, would you like to take this?
Yeah, so one of the most important reforms that have taken place is the move to a cost recovery pricing by the particularly the CEB and the CPC. That was the biggest problem, but there were other institutions as well. So that has actually addressed a very large part of this problem. You know, what happened historically is that the government parked some of the budget deficit on the state banks, and it did that through forcing the CPC and CEB to sell below cost, right? There were administered prices set for fuel and electricity, which were well below cost. And so it was a subsidy. So the government should have actually provided the financing for those subsidies. It didn't. Instead, it forced the state banks to take on those losses onto their balance sheets. So this is but it was a serious means through which the state bank balance sheets were undermined. Now that sequence has been broken, right? And in fact, they're making profits and whatever. So we shouldn't see the same problem arising in the future, provided these pricing formulas are adhered to by the CPC and CEB in particular.
Thanks, Dr. Kumraswamy.
Is that clear? I hope I've made that clear. Yeah. Yeah, it was a problem. The government, you know, as I said, it should have paid the subsidy to the CPC and CEB, didn't, but forced the central bank, the state bank to take it. So it's nothing to do with the central bank. It's to do with the government and the way it managed its fiscal policies. But now also there is another angle through which the policy is being, the problem is being addressed. I believe the new banking amendment bill has introduced strict single borrower exposures, which also will help to address that problem. But the problem shouldn't arise anymore, because if you go to the pricing formula as they stand now, with full cost recovery pricing.
Thanks to Dr. Kumraswamy. Next question actually cites the conversion of the Chinese debt to equity in 2015, I think in the Hambantota port. So the question is, do you see the government taking a similar approach in the period ahead, or are the debt agreements limiting on that? Dr. Kumraswamy, would you like to?
It was a complete misnomer. It was not a debt to equity swap, the Hambantota thing. Basically, the debt was maintained, and it was on the government books, and the debt has been serviced since then. What happened was the port was given on a long lease to China Merchant, and I think it was about 1 billion or 1.1 billion, the lease payment, and that 1 billion was used to settle an ISB in early 2019. So it was not a debt equity swap. It was a long lease. The government took the money in, used it to settle an ISB. and the debt was taken over and serviced by the government, has continued to be serviced by the government. So it wasn't the debt equity swap.
Thanks, Dr. Kumaraswamy. Few more questions have come in. Looking at the latest one, to raise fiscal revenues, wouldn't it be better to rebase existing tax rates as opposed to implementing new taxes, like the property tax? Dr. Smith, would you like to comment on this?
Yeah, I completely agree. That I think there's a need for fairness. I think the big problem comes with the amount of exemptions. So some people pay ridiculously high rates and some people pay zero. What would make sense in a fairer system is that everyone pays a fair amount. And that way you could avoid some of the very high rates that some people are paying. On the property tax, I think over time it makes sense to value properties properly, but that system isn't in place. So they've tried a muddle through, which is a bit odd and not done anywhere else, but will probably, even if implemented, only raise 0.2% of GDP to. So I kind of think that the tax system needs reform, overhaul, and stability. I think they need fairness. They need to stop in-year changes. They need proper guidance. And with that, you work towards a better, fairer, and more sensible tax system. And I think working with small gimmicks to form small holes is a distraction.
Yeah, thanks, Dr. Smith. The next question is, given recent investments, what projections are there on gaming revenue to the government? Is it enough to become a major revenue source? I think this is on the recent announcement, I think, with Melco. Dr. Kumaraswamy or Dr. Smith, do you want to comment on this?
Sorry, I didn't quite follow the question, or should you, what was that?
No, this is on gaming revenue to the government. I think the recent
gaming revenue. Oh, okay.
Yes. So basically, the question is it enough to become a major revenue source?
Well, Greg may know what happened, what has happened in other countries, but intuitively, one would think that this could become a very major source of revenue if one is able to tax the gaming industry. But it needs to be done transparently and in a manner that doesn't totally disincentivize the sector, particularly if we are now getting a large investor with an international reputation coming in. But yeah, it should be a very useful source of revenue. Another thing I wanted to say, just to add on the previous question, what we need to do basically is improve tax administration. We don't need to change taxes very much anymore. If we improve tax administration, there's a massive upside there. And, I've told you about this nexus you have which prevents any reforms. That same nexus prevented adopting RAMIS. Hopefully that has now been overcome. And that tax administration will improve materially. And we need to take away the tax holidays. Once you start making profits, you should pay tax. Mangala Samaruira, when he introduced his Inland Revenue Act in 2018, I think it was, actually shifted from ex-post tax holidays to ex-ante investment allowances. So he linked the concessions to capital formation. So you could set off 100% of your investment upfront in most of the country and 200% in the north and the east at the conflict-affected countries. So, having it upfront and linked to capital formation, in my view, is a better way of doing it than these tax holidays that we have. And hopefully, that I think the Treasury has published a tax expenditure number, that is the revenue foregone through these various tax concessions at close to ₹1 trillion, something like 970 or 80 billion. So I think, as I said, I think Greg said it as well, remove the tax holidays. If you're going to give anything, give it upfront as an investment allowance, and improve tax administration. That will take us a long way in terms of meeting our targets on the revenue side with the current structure of taxes.
Thanks, Dr. Kumaraswamy. The next question is on SOE restructuring. Basically asking whether we can expect any conclusions prior to the upcoming elections. Secondly, given the current inflation outlook and the market lending rates, would you say there is further policy space for the CBSL to relax policy rates? Dr. Smith, would you like to answer this?
I think the CBS seems, at least in my opinion, to be on a wait and see, and I think that's sensible, given the potential for shocks in global oil prices and other things like that. So I think their stance to keep a little bit of powder dry makes sense to me, at least.
Thanks, Dr. Smith. I think we are coming close to the end of the allotted time. I think we've exceeded a bit as well. Although there are a few questions still coming in, I think we will conclude today's session. Some of the questions we haven't taken up actually were answered during the moderator session. So maybe our attendees could watch the recording and get some insights from the moderated session, which we will share once the call is concluded. So thank you very much, Dr. Kumaraswamy and Dr. Smith, for joining us today and providing your valuable insights. Also, thank you very much to all the participants who joined us on the call today. Thank you very much and have a pleasant evening.
Thank you. Thank you for having us.